Okay, so welcome everyone to the Hugh Hendry podcast. I prefer to think of it as the Acid Capitalist Show. You find me uncomfortably introducing the show, uncomfortably because this is the realm of the much missed Alchemist, Mr. Sweeney. Unfortunately, we've not had him for 2 weeks, owing to what? Owing to my hectic lifestyle, which I fear is just going to get more hectic. But we miss him, and I assure you, he will be back. Much missed. Now, we have before I introduce Sir Tom Roderick, the macro maven of London, my former hedge fund partner, the man who brought a clinician's expertise to the insanity of my mind. Before that, I wanted to reach out and welcome any new members to the Church of Acid Capitalism, and to thank everyone who seems to have watched, viewed last week's show with the wonderful Ben Eifert or Neo from The Matrix. We had, I think, 8,000 views on the YouTube platform, and of course, almost as many on the Apple and the other podcast platforms. Now, people, again, you know how vulnerable our political economy and indeed our financial markets are. They're vulnerable to the suits, to the status quo, to the grey men who have the platitudes of the Federal Reserve, the Milken Institute that tells you it's going to be all right. This is a time for panic. We got to get out there. We got to hack into the system to tell the truth. The way we can hack is views and likes. Give us likes. You know, with 8,000 views last week, we got 400 likes. Thank you. I'm raising the bar. I'm that type of person. I'm demanding. Tom knows all about my demands. I'm very, very demanding. Give us 1,000 and we could start to change the world. And more than that, I promise you, we get there, I'm going to pick my favorite like or comment, and I'm going to send you one of these damn silly hats. I've been traveling. People come up to you. You wear an Acid Capitalist hat, and people say, I like your hat. So one's coming to one of you great people when you help us hack the system. So without further ado, as I'm going to switch off my WhatsApp, Tom Roderick from London. How are you, my friend?
Hi, Hugh. Yeah, no, I'm great. Great to be here with you in the Acid Capitalist virtual studio once again after a few months off. How are things in St. Bart's?
St. Bart's, Paris, London, off to Boston this weekend. People, very exciting news this Thursday. We're taking down the mothership at Bloomberg, being very kindly invited for a long stage participation next Thursday. So be sure not to miss that. But Tom, really, you say it's been a few months and a lot's largely gone down, or you could say yields have gone up. What does it feel like? You know, you're a smart guy, you're a strategist. We're tuning in because we want to hear about your moves. We want to hear about how you're dealing with these events and as they unfold and the kind of trades and how you make sense of it. We want to hear less of me and more of you.
Yeah, well, no, it's certainly been a very interesting few months. Yeah, not great if you're a long only investor, but you know, for the macro guys, it's been okay. There's been a lot's been happening. You're sort of hitting policy bounds at every turn. You know, just take a look at what's been happening here in the UK. You've just seen untold political chaos bleeding into market chaos, bleeding back into political chaos again. And so there's certainly a lot of stuff keeping us busy.
Well, indeed, and my concern is that the chaos. I don't see much joined up thinking in the financial markets. I feel it's more reflexive or reacting. And in the case of the British example in the gilts market, you know, the the metaphorical tide shifting and revealing again the hidden layers of leverage. And so and yet I'm seeing comments that the politics are being disciplined by the wise guard dogs of capitalism that we have in markets. God forbid it. Give me some wisdom.
Yeah, it's been a very curious time in the UK, and like what I'd say, the UK has been stressed more than any other market, and so I think it would be fair to treat it as some sort of a forward indicator for what could happen in Europe, in the US, just because it's seen those stress points hit before the stress points have hit elsewhere, and so obviously the backdrop from an inflationary perspective is bad. We're seeing inflation push into double digits. The central bank, Andrew Bailey, is panicking, is hiking rates very aggressively, started a program of quantitative tightening to sort of reduce the level of money supply in the economy. All of that was well and good until you got Liz Truss's economic plan, which was taken very poorly by the market. And you saw rates, particularly in this very long end gilt market, go up enormously. You saw long end inflation linked gilts like actually fall to 50% of their value within the course of a week. And when you have this kind of volatility, things start to break. And something did break. In the pension funds, basically pension funds were taken on. They're supposed to be very safe, boring institutions. They were taken on extra leverage to be able to meet their liabilities. And as the market moved against them, they didn't have the collateral to pledge. They didn't have the cash to pledge, I should say, against some of these market moves, and were forced to fire sell their positions. And as a result, you saw the Bank of England come out and basically announce an emergency quantitative easing once again to sort of underwrite the gilt market. And still yet, it's unclear when quantitative tightening will start again. But for me, this is indicative of the real problem that central bankers are going to face in the years going forward. We have very, very high levels of inflation. It seems to be coming from everywhere. It's sort of like playing a game of whack-a-mole. You start to see supply inflation in the form of shipping and trucking rates start to go down, and then the inflation just appears out of another hole. And the central bankers with their big hammers are not quick enough to whack all of those inflationary moles that keep on popping up. And so there is a real problem. And, the way that they want to deal with that problem is to raise interest rates and to reduce the size of their balance sheet. The problem is, in the course of doing so, they've managed to find stuff in the financial system that is fragile enough so that it broke, and which basically constrains them from doing what they think they need to do. And like another way of sort of illustrating the problem is that if you look in the West, even after the financial crisis of 2008, we never really got our leverage down. Leverage sort of shrunk in some places in the US mortgage market, and it sprung up in other places. And debt to GDP remains very, very high. And so it's difficult to raise interest rates without things breaking. And that seems to be the case, even if you have broad inflation across the whole economy and interest rates are still below the levels of inflation, arguably far lower than is needed to control inflation on its own, still things are breaking, which basically constrains the central banks from acting. And so we're left with this world where the central bankers almost have no choice but to let the inflation run. And, even at the levels of rates that we've got, the amount that people have to pay to borrow money for mortgages in the UK is becoming a political issue. And there's even talk about the government stepping in to underwrite some of the mortgage market, provide an insurance option for the banks to basically allow them to lend money on new mortgages at rates far below the risk price of those loans would be if they didn't have that government support. And so basically what you're seeing is, the central bank is trying to take away with one hand, the government through fiscal policy and through political errors are making them give it all back. And what you're left with is the inflation. It's still there. And in my opinion, there is very little chance that policymakers are ever going to be able to raise rates high enough to actually reduce this inflation, given that as soon as they start to do so, things in the financial system break. And now this is not saying that, there's a severe problem in the real economy. I actually don't really think that there is. I think the problem is high prices. Those high prices may start to come down in areas on their own, but there's a demand side to it as well. And the interest rates required to reduce that demand are not interest rates conducive with the proper function in the financial system. And so we're basically stuck with a system where it's impossible to raise interest rates to positive real rates enough to constrain the real economy, because the financial economy just breaks first. That's the way I see it.
Yeah. So you describe anarchy in the United Kingdom, but we're missing a Malcolm McLaren. We're missing a Svengali to control the chaos. So as I look back on my career as a risk manager, I would have struggled this year because, like, the conversations that we've had, it just makes my blood boil when you say inflation. I really take exception to the inflation. But without a doubt, the belief in that has been the most successful avenue for printing macro profits in managing a portfolio, because yields have blown out. Now, the yields blowing out is essentially interest rates rising. And so, to my mind, it doesn't really matter that the central bank can't get to supposedly much higher levels. I mean, I think it's preposterous. UK inflation, the prints are running at what, 9%? So are we saying that the Bank of England should be at 9-10% interest rates? I mean, that's preposterous. Regardless, the backup in market interest rates times the magnitude, the very fact that they are multiples of the size of the economy, means that the compression and the pressure on ordinary folks' lifestyles is being brought to bear today. You said you're sanguine with the economy. I don't know, in the context of the UK, I don't know where you get sanguine, because it's been in stagnation for some time, and it's now being forced into, I just find, a kamikaze style of fiscal retrenchment and monetary and a desire by the Bank of England to have higher interest rates. And all I can see, because my life is spent not in the present, but in a year, 18 months time, and I see dead people. So how can we reconcile our thoughts?
So, the UK is in a particularly bad situation. It's just got all of these bad things have happened. It's got the bad things that Europe has in terms of all of the energy inflation. And it's also got all of the bad things which the US has, in terms of excess demand from high wages. yeah, I'm not saying the UK is in a particularly good place economically speaking, but it's not. It's also not in the middle of a catastrophic recession. And I think people are screaming recession because they're seeing what's happened to the stock market. Whereas actually, as I think your guest said on the show last week, it's been about the most well telegraphed bear market in history, and as a result, it's been a particularly unvolatile one. But policy volatility is still pretty epic. And also just coming back on your points that it's not inflation. Like, you've had a massive expansion in the money supply. You've had a massive
What?
expansion. In terms of
What?
M2 growth in the US, in terms of
Oh,
the UK.
please stop. M2 is banned from this show, right? Tell people like Tim Congdon and all these policy wonks in the UK, and they still talk that talk. They got kicked out of the advisory corridors of power in the 1980s with Thatcherism and Friedman being at the fore and a desire to measure money. And they discovered they could not measure. M2 is irrelevant. Like, we live in a world which is not the domestic money supply of bank deposits insured by the state and regulated by the central bank. Money supply is banks willing to make commercial loans. And the only willingness just now by the banking sector is being conducted offshore in the dark web of the euro-dollar system. And the lending which is going on is asset price inflation lending. And that now is being attacked with a sledgehammer.
There's no asset price inflation this year, but yeah, lending by banks has been pretty strong. And are you telling me that the man on the streets is not seeing the price of his basket of goods at the supermarket going up? What is it? It's all very well to say this is not inflation. Well, if this is not inflation, what does inflation actually look like? Because, when I look around me, when I think the man on the street sort of looks at how much he's paying on his bills, it's inflation. What am I missing here? How is this not inflation? What more do you need to call this inflation?
You need the ability to see the bends of the future. Like, you have to be able to distinguish between CPI and hysterical, uninformed newspaper and political comments with how economic behavior responds. So economic behavior responds in two forms. Firstly, you have this enormous fire break. So the episodes of hyperinflation from Germany. First of all, the red flag is when you see examples of it, it's in brown sepia photographs, which is to say these are events from 100 years ago. And despite the annual prognostications that is going to happen again, ever since we embarked on Federal Reserve QE in March of 2009, it has not happened outside the arena of asset prices. We have not had inflation in the general. So the fire break is that the bond markets quickly reprice rates, and that affects mortgages. That is causing untold stress and pain today. And then secondly, we live in a world of mercantilism where the people who run businesses are very mindful that if they don't control their costs, they either become zombie companies or in fact they disappear, because it may change, but in the globalized nature of the world, errors with regard to essentially wage costs will lend itself to more offshoring into the avenues of China.
Well, but hang on a minute. Like, I wasn't calling this hyperinflation. You'll surely agree that, on the one side you have a debt deflation spiral, on the other side you have hyperinflation. Most of the time economies are in the middle. They're not that close to the debt deflation spiral, and they're not close to hyperinflation. I'm not saying that there's any sort of hyperinflationary forces going on, but inflation across the board is close to double digits. If you look at the US, the GDP deflator for the first half of the year was 7.6%. And so that's, prices rising across the board. It's not, this is not just CPI. This is all prices measured across the entire economy are rising in high single digits. Like, I don't understand how you can say through some sort of like dark sort of wizardly analysis of the euro dollar system that this somehow isn't inflation. It sure as hell looks like inflation to me.
Well, I'm saying that the elevation in all prices currently sows the seeds of its own demise. That's what I'm alluding to.
And so why hasn't it happened yet then? We've seen a lot of market commentators have been saying this since mid 2021. The inflation will come down next month. The inflation will come down next month. Like, what do you think? Like, why do you think it is that it's taken so much longer? You're still expecting it to come down. Like, why hasn't it happened?
Oh yeah, well, I mean that's really quite simple. So, for it to be something analogous to the 1970s, okay. Well, first of all, I don't believe you can get there because you didn't have the fire break of the enormous mountain of publicly traded debt, which is very quick to reprice and therefore be reflexive in tightening monetary conditions onto the household sector. So that's a difference between today and the 1970s. So maybe there's something in between, okay. Secondly, the Friedman notion of inflation being a monetary phenomenon says that if we think effectively of no banks, but just money and money which is held in your wallet, in the UK example, all prices are up on average, let's say 9%. Now, unless the dollar bills or the British pounds or the euros in your wallet, unless they've quantitatively expanded by 9%, you will be unable to maintain your present consumption. And that's where we fall into this debate where we can separate spending between discretionary, where you have the ability, not necessarily a desirable ability, but you have the ability to cut back or indeed increase. And then you have the expenditure on utility bills et al., where you kind of lack the ability to control it and you got to take it. Now, my sense of looking at markets, because markets are revealing, is that they show that in every sector that you could characterize as being subject to the discretion and the whims of households seeking to control their expenditure, we're seeing presently weakness coming into their figures. The most celebrated example would be the FedEx, who are actually, the invisible man delivering the post office, the global post office. And they're saying our business just radically changed. It went from boom to not a boom, right? So it would seem, when I look at all the realms of discretionary expenditure, share prices are collapsing, and I'm seeing a lot of anecdotal evidence. Wages, when I read, and clearly we all read with filters, but at the weekend, a large UK employers, the British Postal Service, the Royal Mail, they're looking at 10,000 job cuts. They're looking to bring in more temporary staff. They're looking for freezes on wages. I don't see the dollar bills expanding at 9% within this imaginary wallet, and therefore discretionary spending is easing, and that and allied with the tightening from private debt traded markets means that my summation, just like the US Treasury bond market and with its yield assumptions, where they see things getting a lot worse. So that's kind of where I come at it. Where am I wrong there?
Just like firstly, I think that I'll come back to the kind of bigger picture, but on the FedEx and the Royal Mail, I think that may well be a special case that you've picked there. We're coming out of COVID, where you had an extraordinary excess spending on goods relative to services. And, you know, that hugely like boosted FedEx, it boosted the Royal Mail, and they had, you know, the best time ever in terms of, you know, the number of deliveries that were being made. Yeah, those days are gone, and those companies are going to be struggling. And, you know, at the same time, they've been hit in terms of supply chains and stuff like that.
And their cost and energy costs. But Tom, also that's my point. That my reference point isn't with the 70s and isn't with Weimar. You know, and again, before we end, we'll have to reflect on Weimar Ben. We now have to call him Nobel Prize winning Ben, which is just damn absurd, but we'll get there. My point is that boom logistically in the FedEx and the Royal Mail, that was, you know, there was perhaps an understandable error in fiscal policy in sending all those spending checks to American households at a time when 2/3 of the economy, the service economy, was in closure. Okay, and so we elevated demand for tradable goods at a point where supply was restricted by the COVID. And so our blessed market-based economy rationed supply and demand via the mechanism of higher prices. Mm-hmm. So that's, again, which leads me, I get a hair in my throat when I say, I've got to say inflation is 9. It's a kind of, it's an auction, and we've had to bid to clear the supply and the demand, boosted temporarily by an exceptional war-like event. And what I'm seeing is when the supply and demand return to normality, then the pricing is, the CPI is not 9, it's kind of maybe what we saw in 2019.
So I think where we will agree is that, you know, there were special cases within COVID where you had sort of parts of the economy which saw an increase in prices due to increased demand, and in a world of constrained money supply, you would expect to see spending on those goods go up and spending on other stuff go down, and you know, and as a result, you would expect to see not a huge change in the general price level. Instead, all of that COVID stimulus basically meant that, you know, while initially you had the special cases go up, even now, you know, now when those things have kind of come to an end, the massive excess delivery requests have come to an end, inflation is just popping into medical services, into wages, into everything else. And so it seems to have gathered a certain momentum. And I think where you and I would probably disagree is whether that momentum, whether that demand momentum will continue or not. I think it will. Again, let's go back to the UK. You have a government in the UK who have, you know, they sort of decided, okay, we want to cut taxes, but now they've kind of moved away from that and have moved into an environment of wanting to cut spending instead, because they realize that they've got big problems otherwise.
But that's a failure. Why do they have big problems otherwise?
Well, like, they think
the IMF is now running the United Kingdom. Show me an example when the IMF was a success. And, you know, the IMF has been discredited. The whole understanding of macro logic has been discredited with the rise of the global surplus of savings, the dump which is created by mercantilism, where China takes wealth from its substantial household sector and it buys sovereign bonds in the West, right? Look, that has destroyed the IMF model and understanding.
I agree. The IMF, I'm not here to defend the IMF. The IMF model has been a disaster. You know, they just seem to kick a good man when he's down. You know, dubious.
Can I ask you, right? So the UK, I think, made an understandable error for fiscal probity, and it went for retrenchment in fiscal spending in the era of 2010, 2012 to immunize itself from the fear of the European sovereign crisis. But largely, looking back on it, we say that wasn't really the right thing to do, because bond yields, sovereign bond yields, have fallen across the spectrum, either the fiscally rectitude or the otherwise. Yields just fell. and therefore the UK hobbled itself. And for 15 years now, growth has been stagnant. So why, given that precedent, why is it now the right thing to pursue the same failed policy?
So just because a policy was the wrong one 15 years ago doesn't necessarily mean it's the wrong one now. The set of constraints that we face as a world, I think, coming out of COVID are inherently different to the constraints that we face going in. Pre-COVID, we had arguably still a global excess of supply over demand, whereas now we have the reverse. We didn't see the inflation. There was no, people were worried about inflation and runaway bond yields in 2010. It never happened. It never happened in the price data. All I think happened was there was a perception by voters in the UK that this needed to happen, and regardless of the sense of it, that was what was done, because that seemed to be the most politically defendable thing to do. It was wrong. That doesn't necessarily mean it would be the wrong thing to do now. I don't think there should be spending cuts in the UK. I'm not arguing for them. I think that it's inevitable that we're in a higher inflationary world. And so I don't really see that much point in trying to create a severe recession to get back to the post-COVID world. I just don't think that's a sensible course of action. But if you look at what the government has tried to do, they tried to cut pensions, basically got blocked, politically unpopular. They tried to cut the size of the civil service. They've been cutting it for like a decade. It can't really take a lot more cuts. They've been trying to cut, they're talking about trying to cut the NHS, again, politically indefensible, can't be done. They want to increase by 50% spending on defense. That's kind of set in stone. They have to politically spend more to subsidize green energy. They have all of these things which voters expect them to do. In 2010, all voters wanted them to do was to punish the banking system and shrink the size of the state. Now voters want them to do the exact opposite. They're basically demanding for the size of the state to be increased, and no one should have to pay the price for it. No one should have to pay the price through higher energy prices. No one should have to pay the price through higher mortgage rates. They expect the government to come in and subsidize all of it. And that, to me, is where the new excess demand, which has to keep coming to keep that inflationary beast alive and growing, that's where the extra spending comes from. It comes from basically government mandated insurance to ensure mortgages are at sub-market rates.
But that's speculative. So that hasn't happened yet. Whereas the thing which isn't speculative is that they have turned 180 degrees and they are committing themselves to spending cuts. So they're spending cuts. Again, there's the reality that mortgage rates have gone up. Then there's the reality that consumers, you're either subsidizing their energy or you're not, right? If you're subsidizing it, okay, thanks, but I don't feel like I'm going to go and party and spend the money. If I'm an enterprise, I'm not thinking I'm going to spend more capex. Everywhere I look, I see cuts.
Well, I don't know where you're looking, because I'm not seeing any of these cuts. None of these cuts have actually happened. There's a lot of discussion about the need for cuts, and not a single cut has been imposed.
Well, they've just been announced.
They've announced hypothetically we need to cut spending.
We need to, and these are the plans that we will be coming back to you, concrete plans to cut spending again. That we did this before, and we want fiscal rectitude. Fiscal rectitude has no place presently. Put me in charge, I would cut interest rates. I'd be like the sterling, right? Sterling versus I want sterling at 1 to the dollar. That's only 10% away. You don't scare me. Which hedge fund in the world wants to? Not even Chris Minodi wants to short sterling at parity with the dollar, right? It's damn cheap, right? I'd be like, I'm cutting interest rates and I'm cutting taxes. You know why? Because of those idiots in Europe. I want their lunch. They are just smoking the wrong stuff, right? I'm going to be a free Singapore, loving enterprise, loving the people who actually create wealth, and that wealth will propel the UK forward, right? That would set sterling up. Instead, is listening to clueless status quo people who've enjoyed asset price inflation and then go back to saying, yeah, why don't you do fiscal rectitude? Like, why is a broken record?
The thing is, if you were a dictator of the UK, I'm sure you could do all of those things. If you wanted to stay in power in the UK for the next 3 months, you would not achieve all of those things. So all of those things you're talking about are very long-term impacts, which may or may not happen. Whereas in the short term, you're just going to get more market chaos if you sort of do things in like a crazed manner. And so, yeah, you just get voted out. And so, the general public doesn't believe in all of those things. I think generally there is an understanding about why interest rates are going up. They're going up across the entirety of the West. It's not just a UK thing. I think people get that. I think what people are asking for is for the bailouts to continue, and I think they will. I think
sure, the bailouts are definitely coming. They're coming because we'll be in the most dreadful economic circumstances.
I think all of this started when Trump came in and did his tax cuts in 2018, and there was all of this chat about how was he going to spend? How was he going to, make up this deficit? Was he going to put in a border tax? Was he going to increase the tax on something else? And the answer was he wasn't going to do anything. He was just like, fuck the revenue. We'll just borrow more money. And
why not?
Well, why not?
Japan did that for 35 years.
Well, it's all very well if you don't have inflation, right? So I like what I think is to look at a country which has been through this before, Brazil. So Brazil, Lula's obviously coming back.
Sorry, Brazil is not a relative comparator. And let me tell you why. No, hold on. What is the size of the public sovereign debt market as a percentage of GDP in Brazil? And I don't want a precise figure. Like
it's sub 100%.
Less than 1 times GDP.
Yeah,
it's sub 1 times GDP, right? And if you add in all the commercial on top of that, it's no more than 1.5 times GDP, which is to say it's the 1970s, right? There's no fire break on inflation. And that's why the inflation flares that we've seen in the last 100 years have been found south of the border, because there's no fire break. There's no instantaneous repricing of credit, which hits the household sector immediately and causes discretionary spending to pivot lower. Anyway, continue with your Brazil.
Well, it is relevant in the sense that you basically had excess spending in Brazil, which caused a fairly independent central bank to keep on hiking rates. The government basically got around this by slowly but this is the Dilma regime, by slowly but surely subsidizing all of the things it wanted to spend money on, sort of like solving inequality by giving money to poor people, state-run enterprises, big like cash bungs to state oil companies, state construction company, etc. And all of these loans were basically given at sub-market interest rates. And so the interest rate mechanism essentially started to break. And I think, if you do see, you may see the same thing start to happen in the West. If you see subsidized lending for mortgages, that is the point at which Britain turns Brazilian. And, it basically just means that the economy becomes less and less sensitive to interest rates, because you insulate certain groups. And that's why I think it's relevant, because I think you see the same processes potentially happening in the West. Okay, well, let's turn this on its head. What do you think would be the state of the world right now if interest rates were never hiked? If we left interest rates at close to 0%, where would asset prices be?
Well, again, that's I don't accept that because of the guard dogs of capitalism. Like the people whose reputation and livelihood is dependent on guessing inflation and various metrics of the economy, not today but in the future, because they have to have commercial hedging of their activities or speculative activities. But it's they're licking the edge of the razor blade, and if they get it wrong, they die, right? So thousands of these faceless people are making these estimations every day. And I'm saying to you that allied with the scale of the publicly traded markets that they influence, that is the reflexive loop that keeps inflation at bay. That plus the mercantilism of...
Hang on, so just to clarify, so going back to that question, what do you think would have happened? What would have happened to asset prices and the economy and inflation had interest rates stayed at zero? Would inflation be higher, lower, the same? Would stocks be higher, lower, the same? Where would bonds be trading?
I think that inflation would be pretty much where it is. I think that stocks would have fallen more aggressively, but I think stocks are just
more aggressively.
Oh, more like 25% down on this year. It's like nothing, right? And that's on the wide.
So stocks would have fallen more if rates were not hiked.
Yeah, because of how it assaults the grave, chinless wonder who is the marginal institutional thought leader of capital markets. It would completely put them into disarray because there's only 5 people who understand money in the world. It's a complete mystery to all of the market participants. I would turn it back on you. It's 1948. US CPI is 17%. Are you a buyer or a seller of US 10-year Treasury bonds?
Well, and I think actually that time period is pretty illustrative of the current one, because I think you're seeing more and more government intervention and management of the economy with a set purpose. You had relatively, or certainly in the UK, you had pretty high debt after the war. And that debt was basically eroded away as a policy choice. Now, given where we are today, if I was to sort of, if I was put as dictator and could choose the policy choice, I think, the problem that the economy has is that we have these massively elevated asset prices and debt relative to GDP. And the only way to get that down is to have negative real rates for a substantial period of time. The easiest way to have negative real rates is to generate inflation. The easiest way to generate inflation is to expand the money supply. Either, you can try and do it via monetary policy. It's not that effective. If you do it via fiscal policy, it's pretty damn effective. Particularly if you do it with fiscal policy targeted at low-end workers, low-wage workers who then generally seek to spend most of the money that's given to them, and that kind of circulates through the economy. You get higher nominal GDP growth, and you would hope eventually at the end of the process, you have less of this debt, and you remove the sort of the knife in the steering wheel that high levels of debt and combined with actively traded markets have on monetary and fiscal policy. I think the only way to remove that knife is to inflate away the levels of debt. And I'm not saying that this is a deliberate plan on the part of policymakers, but I think it's something that they sort of stumbled into and will basically continue down this path. If you
I mean, I'm gonna have to take one of my calming gummy bears things. I think you just gave us again classic orthodox economic thinking. Because I know that you're a great believer in the kind of inflationary potential, the nudge potential from fiscal policy. I'm not so. I actually think people are smart enough where when you create, China demonstrates this, when you create GDP growth through the arm of the government, private enterprise is like, I ain't buying it. I am not buying it. All right. When Japan sent checks to household spend, people were like, nah, something's kind of fishy about this. When you subsidize energy prices, which you have to do, I think, in Europe, it's like a warlike situation. If you're not going to be sending troops and tanks and stuff, then you've got to kind of take the expenditure elsewhere. But again, I say to you, you subsidize all of that expenditure, that people don't go, wow, yeah, really enlightened government, I really want to invest here. They go, nah, people, the genius of wealth creation is they see the absurdity and the hollow nature of fiscal intervention, and it doesn't get you out of these forms of mild depression-like circumstance.
Well, I'd say the genius of China in managing to deploy all of that investment spending was suppressing wages at the same time, because that basically meant you didn't have that monetary velocity. If instead of doing that, they just given everyone money, I think you'd have a very different story. But anyway.
I don't disagree with that. But again, we can't displace that. They have consciously shifted trillions of dollars of potential consumption from their citizens, right? They've taken it. Like, there's a deficiency of demand in the world. Like, we have, for 15 years, we've got nowhere close to attaining the previous global trend rate of GDP growth. There's each year, a profound deficit opens. So we're missing spending demand. And we're missing it because of that Chinese policy, where it would be spent in China. They deny it because of politics, and they put it into open sovereign bond markets like the UK, like Australia, like the United States. And what it does is it breaks our system. It breaks the ability to allocate between creditors and debtors and create a market rate of interest, which actually can encourage entrepreneurship. And instead, all we're left with is speculation.
Do you think that those days are starting to change? Because, when I look at China now, they're starting to rein in the investment spending. They're not really managing to shift towards consumption, but I struggle to see China having the same impact on markets and suppressing inflation in the next decade as they did last decade. I don't know if you see it the same way or not.
I do not see this. I don't know what you're looking at in old London town, but in the sunshine of St. Paul's, I ain't seeing that. I mean, the GDP calculator of the Chinese Communist Party is broken. They are floundering, and they got, like, the great work that you authored. There are 90 trillion insane bubble. What they do with it, what do they do with it? The fear is that a currency which trades, where is the renminbi versus the dollar? 720, let's say, 725.
Yeah, somewhere around there.
Yeah. In an orthodox world, it would be trading in an orthodox world without the Communist Party. It would be trading at 425, i.e., Chinese household sector would be wealthier and spending more on overseas goods and services. As it is, what if they devalue the currency to get the mark on their property down? The comparative figure for the US, which we all fear is overstated as well, is $36 trillion. I mean, the magnitude is. So my greatest concern is, like, all of the legitimate fears that we had 10 years ago and which stretched into 2015, which are now all dismissed as cranky. They all, like, what if we're looking at 9 renminbi? What if we're looking at 10 renminbi? Again, are you a buyer or a seller of 10-year treasury if we've got renminbi trading somewhere wide between 9 and 10 versus the dollar?
Well, I think it's hard to answer that question, because you don't know what level treasury yields are going to be when you get to make that call, do you? Like, you'd imagine that would be quite a bad
lower than they are now, I think. But
yeah, I imagine quite substantially lower than they are now.
But again, that's my fear, is the unintended consequences. I just fear that there's not great wisdom. I mean, I know there's not great wisdom. We've given Ben Bernanke a Nobel Prize for his acuity, his foresight the guy who did not see the scale of the problem of mortgage-backed securities and how it would envelop the global financial sector. The guy who was Federal Reserve Chairman when the global financial sector went bankrupt. And we give him a Nobel Prize because he was the guy, he was the guy denying it all. So, my God. Anyway, so much entertaining back and forward. I feel like I'm a radio host, but the people back home are like, guys, shut up. Right? I'm listening here. Give me a damn trade. I want Hugh, shut up. Tom, tell me your portfolio. Right? How, like, where are you? Because that reveals more than the oratory of certainly the absurdity of my oratory.
Well, I'll tell you some things which would be more down your street. I actually think, what we were talking about in terms of real rates, US 5-year real rates trade at like 1.8%, which means that, between now, over the next 5 years, if you buy a US inflation-linked bond over 5 years, you get a coupon of 1.8% plus whatever inflation is. I'd say that's a pretty good deal. In a world where things can quite easily break, I don't think that real rates can realistically be that high over that period of time. And I think the interesting thing about this trade is I think it works both from mine and your perspective. From my perspective.
Sorry, Tom. Can I just because
sure?
we have an assumed degree of experience and knowledge. So when we say that 5 year, the break even's 1.8, we're not saying that that's the market's estimate of inflation over the.
No, this is the real rates.
It's like a risk premium that you get over and above what you're receiving.
Yeah. So if you buy a Treasury inflation protected security, what you get is a notional which inflates by CPI every year, and in addition to that, you get a coupon of 1.8% on the inflated coupon, and so you're basically you're basically getting compensated in two ways. You're getting compensated for inflation as it comes in, and you get an extra 1.8% on top of that.
Yeah. And to put that in some historical context, which was my favorite, I want to say that post 2008, that has traded flat to negative. I want to say that in the absolute liquidation nightmare of the fourth quarter 2008, it exploded wider and probably was in the region of 4. Yeah. And so if we're not, and I think market equity direction is still lower, but in a grind. So I don't think, I'm with you in the sense that I don't see a 4, like a crash, which would transform that 1.8 to 4, which is an environment where that trade would go against you. Yeah. So I think we're guessing that 1.8, let's call it 2, is the new 4, if you will. That's where we've pushed real rates to such a level that unless they back off, you are going to be dealing with very weak economic growth. Yeah,
and I think also, like, unlike in 2008, the reaction mechanism of the central bank is much more on top of these things. The Bank of England directly intervenes in their own inflation-linked market. I think, you'd presume that the Federal Reserve would do the same thing if you saw rates get into crazy levels. The scale of leverage is such that they can't go to those levels without the financial world imploding. And so I do think that we're in an era where central bank intervention comes much more aggressively than it did before. So you've always got that risk that they're asleep at the wheel and they decide to kind of do nothing in a sort of like a debt deleveraging style event. But at the same time, I think, as long as you avoid those kind of once in a generation financial crash style events, that's a pretty good coupon.
Yeah. Um, which, which in another world, there's the proxy for that for all the people back home. Are like, oh, great, right? Okay, I'm gonna da 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 da. I'm gonna rush out and buy my tips. Um, I guess that would be an argument in favor of gold, which has a, a tight both intellectual and price correlation to that.
Yeah, you could buy gold. Like I would have thought most people could find their way. There's ETFs where you can buy tips. I'm not quite sure what the duration is on them. Then there's a variety of ways which all investors can sort of get access to those kind of trends.
No, absolutely. Absolutely. I mean, again, I would not urge anyone to buy gold until we see a more robust positive price trend. The question is not knowing the future. The question is knowing when to play the future.
Yeah, no, exactly. Like, I think you got to be a little bit careful. But like I would say it's definite. For macro, it's just there's a lot of different trades you can do right now. It's you're seeing unprecedented economic volatility, and we seem to be like colliding with sort of economic constraints and financial market constraints all over the place. And so, this is obviously, not a great time to be invested as a long only guy, but as a sort of like
Tom, so here's the weird thing. Apart from shouting inflation, right? From the macro and the pool of profits this year, macros is all in rates. The weird thing is that, well, you would assume you'd be long industrial commodities, gold, etc. Except they're all crashing. They all feel deflationary. So again, can you just kind of bring it round again, whereby we have a yield curve for the most magnificent market ever, the US Treasury, and it's going, guys, policy error, this is going to really hurt. This is the most predictable policy error ever. You've got like oil not crashing, but like down by a large magnitude. You've got everything down on its ass. How do you bring them together?
Like, I think the market has no consensus about what's going to happen next year. There is a huge lack of consensus, and this is especially true when you look at energy, or if you look at metals. Like half of the world is screaming about a structural deficit of oil, in the US, but across the globe as well. There's a shortage of refinery capacity. The US are not putting any more on. There's how much the Saudis could even do if they wanted to is pretty dubious. If China comes back to anywhere near normal demand, that's going to have some extra demand. On that side, well, and also the SPR is basically run completely dry, like lower than it's ever been. You can, any sort of oil market specialist is going to be outrageously bullish oil right now. And against that, you have the macro, where you've got a lot of people being very, very worried that the level of interest rates are going to break more things. And, what happened in the UK is a precursor to the same thing happening in Europe and in the US, and expecting a significant downturn in demand and a big recession. And so I've never seen
so you get paid not to be consensus. So yeah, I see those both sides. Fortunately, I'm going surfing this up. Well, actually, there's not much waves. But whereas you got to go back to your Bloomberg terminal and put some trades on. So this is why we're talking. Like, so how do you cut through the consensus? You do nothing.
So well, I think the thing is you've got to you need to when you're constructing a portfolio, there are many things which have those exact same macro factors going against them. In terms of recession and doom and things going to break. There's many trades which have that. Where there are relatively few trades which have those extremely positive micro fundamentals. And so, the easy answer is go long oil and short something else against it, be that stocks, whatever you want. Just buy the micro story and hedge out the macro risk.
Yeah. Well, what are you doing?
Well, what would you do? What would you do if an analyst came in to pitch to you, hey, this is the state of the oil market. I don't know what I'm just telling you the facts, but I don't know what the trade is. What would you be doing?
I mean, right. Well, I mean, so talk me off the cliff of the steepener, right? Because we're on wides. I mean, the worst thing is we've arguably taken out the wide. What are the wides? Like, these things have historic observations. We have highs, we have lows. We're talking about the differential yield between 2-year and 10-year. We're thinking that the 10-year yields get a little bit sticky or anchored at higher levels because we have to conceive of future policy decisions like subsidizing everyone in the economy, whereas the 2-year could follow Fed rates to zero in extremis. We're trading at historic levels where if you take on that spread, you've historically made out like a bandit. But like when we're challenging, when we're making wider wides, it's kind of saying, has the system broken? Is it no longer relevant? So I don't know. Where are you on that?
Well, I think the problem is with steepeners is that this year, anything that you've done to sort of make a trade more complex in fixed income space has just been a total waste of time. The trade has been, from January the 1st to today, just sell all bonds, pay every interest rate swap you can find, and don't worry about it. And that market, in terms of like the fixed income market, that's still the way it's trading. We're still pushing higher highs in yields on all parts of the curve. And so the guys who are paid to think about this stuff aren't thinking about it because the first order stuff is making them so much money or losing them so much money if they're getting it wrong that they don't worry about it. And I sort of think for that trade to work, you need to first see a change in that market dynamic where rates just shift higher and higher and higher. And like, do you need to see
policy rates just break?
Yeah, all policy rates break something.
That's the bear, Stephen. I mean, that's what I would be like.
And to be frank, if you'd have asked me at the start of the year how much stuff would have broken with the US 10-year going to above 4%, and the UK 10-year going to like 5.5%.
Oh, sorry.
I would have said an awful lot more than has actually broken. So even me, who was like, a relative bull coming into this year on GDP and on stuff not broken, have been very, very surprised at the lack of carnage given just a spectacular rise in rates. And, is it to come? I don't know. We're seeing surprisingly, you've seen little pockets of leverage get broken, but really very little system-wide damage, which has been a surprise to me. And I think it's been a surprise to everyone. And it is quite difficult at the moment to know where is that pain point. Like, what is the thing that breaks? I can't tell you. I don't know what the thing is that's going to break first.
I think my feeling is, it's beholden on me to offer something back and not just bat it back to you. I keep saying you don't have to be in the casino at all times. There's a commercial necessity with clients. You got to have trades. You got to be invested. Otherwise, they're going to take the money away. We can't have them take the money away. But I feel if we use the S&P being the center of some form of kind of crazy universe, I think it's going to keep like this market for circumstances to change. There will have to be, I believe, a policy pivot. And I think that equities no one's leveraged into equity. There was such a mess, such drawdowns at the start of the year that, and vol hasn't worked. We were discussing this all off camera. That delta one equity positions are low, and the markets kind of go 25% down, knocking on the door of the Fed. Oh no, nothing. We're still worried about inflation. 35% down. We haven't been there yet, but I think we will. And if the response is no, nothing, and then you keep coming back at 10 percentage point intervals. And I kind of feel like I don't really want to engage in these markets until the S&P is down like 40%. I'm willing to take the risk of being early on some macro trades, which would be betting on policy error and then having to come in and bail out collateral values to stop just the complete unwinding of the universe. It's kind of some. My thing is, I like your real rates. I mean, the argument we've been discussing this argument, heavens, for about 8 years, that the real rate on that five-year metric was just too positive in the 1980s, the 1990s. And almost in the early noughties, it was too positive for the creditor community. Who are the creditors? China. Apple would be a creditor. It's got way more cash than its investment needs. But the genius or the momentum of our economies comes from the debtor class. The Steve Jobs in his garage. He's like, yeah, I got these ideas, but I get no money. And so market interest rates come together. And we over-rewarded the creditor community. And moving forward, like, I'm a debtor. I've got debt coming out my damn eyeballs, right? That's what I want to be, because I think they have no choice but to have zero or negative real rates. So when you say real rates now are kind of back knocking on 2, I'm like, yeah, I like that, because I think they should be -2. But again, do I want to do anything with the S&P like down 20%? Not really. So I'm still just being curmudgeonly.
Yeah, because the S&P down 20% since the start of the year. Another way of putting it is the S&P is still up 15% since the start of 2020. Yeah. Hardly what you'd call a bear market, right? It's been in 2.5 years, we've rallied 15%. You've probably got some dividends on top of that. Nothing to see. Nothing to see.
The Federal Reserve's like, yeah, go away.
Yeah, come back when you've taken out that late 2019 level, and maybe the Federal Reserve will actually start to worry, because so far there just hasn't been that many worrying signs in the US. Obviously.
Then I want to own oil, and there's so much that I want to own. But like, not here, not now. And people like saying, "Oh, you're just such a coward." Like, you go and be brave with other people's money. That's what you do all the time. Heads I win, tails I win. You, who the hell are you? Like, you lose. Like, that's not my business. Anyway, I know that's not your business either, Tom. And we've taken up your time. It's all. I do like our. I hope it's not boxing. I hope it's more Federer and Nadal, and we're returning. I think your forehand's a bit stronger than mine. I'm gonna, I rely on the backhand and a lot of nonsense. But,
just remember, no tears. We don't want to see tears on the Acid Capitalist podcast.
No tears. Absolutely no. Only joy when you come to recognize the impermanence of the universe. You free yourself from the shackles of other people's expectations. And talking about expectations, I do have expectations. I have expectations that the tribe will continue to hack the damn system. Like, we're still getting, like, Jon Stewart, like, the comedian guy, he's kind of funny. He had a show, and like, he's got some damn economist called Hank on a show. I should be on the show. Hank only just talks about the status quo. Yeah, the Fed's got it. Really? People, give us 1,000 likes on YouTube. Go into that damn podcast on Apple. Put a review, like, say whatever. But like, the only way we're going to get out there and actually you need to speak to comedians if you want to change the world. And so help me please. But comments welcome. Tom, please hurry back, and great good fortune for your endeavors till the end of the year. Ladies and gentlemen, this has been an Asset Capitalist show without the Alchemist. We are working to remedy that. Let's hope next week we have the Mad Hatter back. Thank you very much.